And welcome to Selfwealth Live, the technical analysis edition. We're here this week once again, and it's exciting to be here with another week of this format here. Jace, how are you today?
Hey Rog, I'm good. I'm good. Glad to be back on the show to talk about all the movement we're getting in the markets. So yeah, I think we've got heaps to go through.
There is a bit to go through. So welcome everyone who's on the other side of our screen, obviously, being able to come here once again. It's a pleasure having you here. As you know, if you've been here before, what we do is our show is specifically designed around understanding and reading pricing charts and technical analysis. So if you have any questions around that, then please put them through to us. We will go through our Australian market, the US markets, and then the Hong Kong market, because they're the three markets we offer at Selfwealth, which is the show is obviously brought to you by Selfwealth, with the help and assistance with Jason from Motion Trader, who's our expert around these topics. So once we've gone through those three markets, if there's any general questions in there, I will try and answer them. And then we've got the second half of the show is all about your tickers, right, where we analyze your stocks from a pricing and a pricing charting perspective, technical analysis perspective. So hopefully that's clear for everyone. So if you're here looking for sort of fundamental analysis and wanting to learn about the company performance and profits and earnings and revenues, then this is probably not the show for you. But having said that, what you can learn on this show can complement that knowledge as well, right? So that's why it's a great show to be on. All right. So thanks. Hey Bob, hey Roger, hey Stackheads and Jacques, welcome to the show. If everyone else is here and can hear us, then say hello as well. We look forward to seeing your tickers come through and questions. Other than that, I think let's have a look at the disclaimer to start off with. Thanks.
Yes. So everything today, general commentary only, no personal advice. And I'll quickly put up our disclaimer that we do each week, and that just goes through that. I'm also not part of Selfwealth. I'm from Motion Trader. That's my business. You'll see my details at the top, licensing, etc. And below there is Selfwealth, licensing, general commentary, all that sort of stuff in there as well. So there we go, Rog, all done.
Beautiful. Thank you very much. Now, don't forget, once again, if you don't want to wait, then like and subscribe on this channel or this video. If you want to put your comments down, I try and read them as much as I can. And if there's any questions, look, I appreciate all. It's been some wonderful feedback over the year and a half we've been doing this, Jason. I really do love seeing those appreciative comments of our show, right? So it's great to hear. So keep on putting that in. It's much appreciated because it also helps the show as well get more viewers, which is, I guess, that's the aim of the game when you're on YouTube, right? So all right, so let's get on to our Australian market. It has had another leg down. How is it faring today and overall, Jace?
Okay, so let's have a look at the ASX 200. So here we go. So after back-to-back up weeks, so last week and the previous week, we got our first back-to-back up week since back in early February. After a decent couple of weeks, the volatility has very much returned to the ASX 200, and this is something we did speak about last week. So last week we talked about this very much this possibility, and I think we need to be on guard for a structural shift where instead of dips being bought along rising moving averages, we move into an environment where rallies are sold below declining moving averages. And one of the clues that more volatility was coming was that this rally off the low, it just didn't have a great deal of power to it. It lacked the snapback quality that we've seen in other rebounds. So, for example, just looking at this, the panic sell in August last year, and then it was a snapback rally. You can see this time around there's no snap. There's no snap to the rally. It's very much a lackluster bounce off the low. And that's something we should look for. Well, I think it's something we should always look for when we're looking at charts, whether it be the ASX or a stock or the S&P, whatever it may be. Look for this sort of price action when you get a market that's consolidating below declining moving averages and is unable to gather much upside momentum, then I think that's when you have a vulnerable structure. And this is when we need to be on alert for potential of further volatility. Now, I want to go across and have a quick look at the equal weight, the ASX 200 on equal weight basis. So that removes the influence of the banks and BHP and those big stocks, ranks everything equally. So what we've got here, we got a nice rally off the March low, but then it stalled underneath this resistance point. You can see as you run along this blue horizontal band, going back to last year, several highs, and then a low from December last year, and now it's working as a technical barrier again. And this is the environment we're now in, where the market is finding it difficult to get through resistance points, also difficult to get back above the declining moving averages. So the structure has very much shifted from, as we talked about a moment ago, from buying the dips to selling the rallies. So this creates an environment where I think there's just greater risk of lower levels. Now, I'll show you what I mean. I just want to compare. I'm going to compare this recent period to, let me just compress this chart a bit. I'm going to go back. We've got a little bit of a delay in the chart loading. Here we go. I just want to have a look at this period. So this is a period from late 2021 going into 2022. I'm just going to put a box around the period of note. So just I want to compare the current period to what we have back in 2021. So you see what happened here. The market was trending nicely, all-time highs. Then it started to just trade sideways for a few months, made its way below the moving averages, rallied back to the averages, couldn't get back through, started to pull back again, and then a larger decline ensued. Now, come back over to present day, and you'll probably notice a similarity. Markets trading up to highs, several months of sideways price action, like we had back in 2021. Then the structure changed. We went from above moving averages to below, rallied back towards the moving averages, and then there was more weakness came back in. Now, this isn't to say the current situation is going to resolve the same way as it did in 2021, 2022. It's not like this is a roadmap for what's going to come. What happens from where we are now is going to be likely to be completely different. It's going to have its own unique pathway that it follows. But the point is that ongoing weakness is more likely to develop from consolidations when they're below the moving averages. So this is where I think it's important to be aware that the structure has changed and that we've gone from consolidating above moving averages to consolidating below. And that's where the risk opens up. So I want to stress that I'm not suggesting that a bear market is coming. As I discussed last week, and I think probably the week prior, several months of messy range-bound consolidation is entirely possible. So whilst we're below these moving averages, it disengages the upcycle, but it doesn't mean that it's then got to go into a bearish tailspin either. It could just mean several months of chop and mess. But risk does elevate, so we just need to be aware that the structure has changed. But I think we need to appreciate that there is vulnerability to this current structure, and then we just need to plan accordingly. So I don't think this is a time for excessive risk taking or letting losing trades get away from you. If the stock's not working, it's like I just want to get it out of my portfolio. I don't want to be holding on to stocks that are declining, particularly in this type of environment. So just coming back to the ASX 200. So how do you play this? Well, firstly, I think it's about having a plan to follow. And for me, the time to be bullish is to be, buying when prices above rising moving averages, that's going to be part of my plan. And then when prices are declining below moving averages, well, that's when my plan will move me to a defensive position. I did continue to lighten my exposure during this rally over the last couple of weeks, and that's something we spoke about last week. That's something I was doing, but I'm still long stocks, just less long, a bit more cash, and I'm using those wide trailing stops we always talk about. And the aim is to see off consolidations where possible. So if the market just remains volatile but generally doesn't go into a larger decline, well, hopefully those wide trailing stops will keep me in some of my some positions I have which are still highly profitable. But that's what the wide trailing stop's about. It's about giving stocks room to move, but then having that exit point should things continue to deteriorate. And I think the key now is protecting capital when conditions are difficult. There'll be plenty of time to make money when uptrends invariably do return. We just don't know when that is. So it's play cautious, play defensive until we get a better structure with prices above moving averages, not below. And that will, as I say, that will happen. But you just got to wait it out. And Rog, one more thing just before we jump off this. Last week there was a question about a dead cat bounce. What's a dead cat bounce? We talked a little bit about it, and just by chance something popped up in my X feed through the week, which I thought was quite topical and quite entertaining. So here's a dead cat bounce. For anyone who's not sure, there you go. There's the Dow. Here goes your cat off the top, hits the bottom, and it doesn't bounce much, and over she goes. So, Rog, if there's any confusion about the dead cat bounce, that's what it is.
Yeah, well, it looks a bit like what's happening now on the ASX, and I'm pretty sure it's the same with the US chart. Let's have a look at those ones.
There we go. Well, look, there you can see there's our cartoon, and here's the actual price action. There's quite a good likeness, isn't there?
Yeah.
So this is really interesting. So we've discussed the potential for a retest of the low last week and the week before. So we had that initial bounce. It was like we looked at an indicator which showed the percentage below the 50-day moving average. And you can go back to the previous videos to look at that. And we discussed the prospect of a bounce, then a retest. And now we've got that retest. And this often happens in these situations. There's often an attempt to rally off the low, followed by the retest of the low. And it's really interesting to look at the price action from yesterday in the S&P 500. So the market gapped lower. So you can see where the previous close was. Then you can see where the next open is. So you got this gap at the open. Prices sold off to just below the mid-March low, but then from there they rallied through the day and closed near their highs. So this is a sign that there is some buying interest, or some buying of the dip interest starting to emerge. So that's positive price action, and it's a type of price action that can occur near important lows. Saying that, I don't want to get carried away over one day, which does look encouraging, because I don't think we can overlook the fact that there has been a lot of technical damage done over the last few weeks, and particularly so when you look at the Nasdaq and the Russell. Just quickly looking at those. So looking at the Nasdaq, its price action looks worse than the S&P 500. It traded further below its mid-March low, and its rally is really just back around that mid-March low at the moment. And looking at the Russell, the small caps, again, there's a lot of deterioration in that price action as well. So as I say, there's lots of technical damage, and it's probably going to take time for that to repair. I don't think it's a case that will be I think it's a low probability scenario that prices quickly rally back to new highs. I think it could be more of a process of as I was saying with the ASX 200, maybe a period of messy price action for several months. one thing I want to have a look at, it's I'm going to, like, we've got the 50 and the 100-day moving averages. That's what I'm normally looking at, but I'm just going to take them off. And this is something I showed viewers of my strategy session last Friday, which I think is interesting going through and having a look at here. So I'm going to put on a 200-day moving average, a simple moving average, 200 simple day, a 200-day simple moving average. So that's what we have here on the chart. And so what you'll notice is that the S&P has mostly been below the moving average for the last couple of weeks. And what's interesting, when you look back at other times when the market's below its 200-day moving average, so I'm just going to compress this chart a bit, and you'll notice as I scroll back, the S&P 500 occasionally has these little dips. You just see where I'm pointing, these little dips below the moving average, where it briefly goes under and then it snaps back. And we can go back a long way to do this. There are a couple more in there. We can do this going back. You can do this yourself, going back through the 80s, the 70s, 60s, 50s, and the same sort of pattern is there. So you get these brief dips below the moving average, but then you get these lengthier ones as well, and some of the lengthier ones also turn into large bearish phases. Now, what you'll notice is that if there's going to be a quick rebound, like looking at these two here, just for example, if there's going to be a quick rebound, they tend to happen within a few days. Let me just find another one. Here's another one. It's just lasted a few days. It was a few days below the 200-day moving average. If you get a situation where the S&P 500 stays below the 200-day moving average for a few weeks, well, then it's often a warning that there's a longer stay below the 200-day moving average in the making. So you can see this period from 2010 spent more than 2-3 weeks below the 200-day moving average. It turned out to be a longer period. Same occurred during 2011, and you can go through, you can find plenty of examples where if it can't quickly retake the 200-day moving average, it's signs of that there's a longer consolidation, or even a bearish phase, like 2022 could be in the makings. So you look at the current price action, and well, it's not a quick retake of the 200-day moving average. I think we're into the third week now below the 200. So I think this is something that we need to keep an eye on. Which is more likely, a multi-month consolidation or a bearish phase like 2022? Well, I don't think we can tell. We can identify setups that have higher probability of leading to trouble, but we can't see the future. We don't know which form this is ultimately going to take, if it's either of them at all. And I know that frustrates some people, and they say to me, look, you say this could happen or that could happen, but you're not telling me what will happen. And I can't tell anyone what will happen because I don't know. There's no certainty with any of this. It's that's not how this works. But I think if you can understand the possibilities, and if you can understand when the risk environment is either in your favor or against you, well, then I think you're in a better position to prepare and play what comes. And then not be driven by the headlines, not be driven by the panic and emotional decision making when sometimes ugly stuff happens below the 200-day moving average. If you understand that's the current setup, you're probably going to be more inclined to playing a conservative game until we can see prices back above this important technical marker. As I was saying with the ASX 200, I think now's the time just to play that more defensive game until prices can stabilise, get back above the moving averages, be it the 200 or the 50 and the 100, which I usually look at. And this could all blow over. This could all blow over in a few months. But until we have a more positive price structure, I think it's time to respect risk. And I think now's the time just for caution and knowing your exit strategy. If prices rally from here, well, terrific. But I think we need to also have our downside covered in case the situation worsens, which is always possible.
Okay, fantastic. And on that said, you were talking about high probability setups. My question for you: have you purchased anything over the last week? Any high probability setup examples that you could give us, or you've completely stayed out for now?
Yeah, I've bought bits and pieces over the last couple of weeks,
Hmm.
but I think there might have been one or two gold stocks in there. There was a stock. One, I'll put one up
Just
just
as an
because
example of a high
just
probability
because
setup.
the code comes to mind. Look, I wouldn't call it high probability. Nothing's high probability when the ASX is below declining moving averages,
Mhm.
unless maybe something like gold. When you got the gold price moving, maybe that's higher. But this isn't a gold stock. It's and I'm putting this up. This isn't a special situation, so I generally suggest people don't rush out and just buy it because I bought it because I buy plenty of stocks which go down.
Mm.
And but for me, the setup warranted. I had a signal for it, and the setup warranted. I take a position because it's frustrating sometimes when I get a signal if I don't take it because I'm concerned about the market, and sometimes it takes off and I haven't taken a position. So what's happened with this one here? This is a on its own merits. This is a nice structure. It's gone from below the averages to above. Here's a signal. It's a motion trader stock. First signal would have been in mid February. It's continued to trade sideways while the moving averages have caught up. It's a nice setup. It's a stock which hasn't been inflated. It's had a tough period over a couple of years, but it's starting to turn higher. Now, will this trend continue? I don't know. It could. Where is it at the moment? Like it's trading a bit lower today. This trend could fail, and it could fall back below the averages. But I'll get out. I'll have an exit. I've got an exit plan. I've got a stop loss. If it stalls here and rolls over, well, I'll get out. But if the situation in the market stabilizes and maybe there's something going on with this company and it trades higher, well, I want to be on board. I've got a smaller position. I didn't take a full position in it because I'm playing it defensively. So there are some situations I'll consider. So I've considered this one. I actually bought it as it looked like it was breaking higher again a couple of weeks ago. So I'm a little bit underwater already. But I didn't want a situation where I could see, look, the market's been struggling. This is starting to break out of a consolidation. I don't want to be sitting on the sidelines and then see it's rallied again. I'm going, well, I should have bought it, but I didn't. So I bought some. We'll see how it turns out. But the odds of a trade working out, they're just typically lower when you've got the ASX 200 below declining moving averages. So I don't expect to make much money. I don't expect to make money during this period overall. I expect whilst the ASX is below its moving averages, I'll be giving money back that I made during the previous upcycle. But as long as the give back is slow and it's not deep, I'm protecting most of the capital. So I'm taking little hits, and then when the market turns higher, I'm ready to go again. We can start taking more signals, be more aggressive. Buying stocks in a rising market is where you make the money, and not taking too much damage during the part we're in at the moment is just how we prepare for the next upcycle.
Yeah, fantastic. Well, obviously, there's been examples even in my watch list of companies that I've missed the opportunity because I'm sitting on the sideline a little bit, right? But as you say, you've got to really have the confidence to do it. And I think for me, it's sometimes sitting on my hands, right, and just going, let's wait for it to play out a little longer and see where the overall market goes. But that's me. Obviously, everyone does their own thing. Let's get on to the Hong Kong market.
Hong Kong. So where are we here? So we're starting to get a bit more of a pullback. We've had a couple of weeks of pulling back towards the moving averages, following this nice trending period from from mid-January. I think the overall structure here still remains positive. Rising lows over the last year or so, and so far this pullback is it looks quite corrective. It looks like it's finding there's interest in buying the dip because it's quite a it's taking its time and pulling back. There's not a rush to quickly lock in a profit, and it's more a case of a grinding move back, which is often due to there being bids below the market as it pulls back. So if I was long the Hong Kong market, I'd be happy to stay long the Hong Kong market. It looks constructive. And when we go over to the Chinese market, well, again, it's struggling to hold on to its gains. Had a good up day in mid-March, but since then it's just been grinding back lower. It's right on the 50-day moving average at the moment. So I think this is where it really needs to hold the line. As it stands at the moment, there is this series of rising low points. So that's the makings of an upward trend. But as I say, I think the key is holding this 50-day moving average and getting another push to the upside. I want to see something impulsive to the upside develop, and then if that were to happen, then this all starts looking like a large basing structure. But I think the key is what happens where things currently are. If we come back next week and we've got a move like I've just drawn in here, it starts to then it looks like sideways at best. Maybe it tests lower. It's out of sync with what's going on in Hong Kong. So that's the two are correlated and they're related, but we're not seeing that strength just yet in the Chinese market. Maybe Hong Kong's leading, China catches up. We'll see. I'd probably be waiting at the moment, but if I was watching it with an interest in buying, I'd probably, if we saw a strong rally above the March high, that could be a trigger. That could be a trigger to entry with a relatively close stop just below the 50-day moving average. But we don't have that price action just at the moment. It's just something to be aware of, something to watch.
Fantastic. All right. Kirby says, no, O'Neill, follow through day index rise 1.5% on increased volume 3 to 7 days after reversal from the low. So he's following O'Neill. Are you aware of this at all?
Yeah. O'Neill's got some really good stuff and some really good technical stuff in there. It's about we talk a bit about this when we get breakouts. It's like you want to see follow through buying, and when you get a false break, it's where a market has broken upwards or broken lower and then hasn't followed through. So, and a recent example of that was with the S&P 500. It broke higher. It broke out of this little congestion band, broke higher, and it stalled and fell back. There was no follow through buying, and we were just talking, I think, a moment ago. It was more about reversal days. Well, that's a reversal day, but it's a bearish reversal, not a bullish reversal. So there's some interesting buying that's come in on Monday for the S&P 500, but we want to see follow through on that, and that can. That's why I say one day is interesting, but it's not it on its own. There's a lot more that needs to happen.
Yeah, for sure. And when we go to the next level with our production, we will also introduce theme music, Jason, because Roger at the start did say that the theme music we need today is the Teddy Bear's Picnic. All right. So when we increase our budget around production, we'll definitely include some theme music there, Roger. Thanks for that. I will get some. Thanks, Baz. I will get some classy art for my background. I have got a plan, but yes, I agree. We've lost that competition. I've lost that to Jason this year so far. So, but I'm on the case there. All right, let's get on to let's have a look at some tickers. We've got a few to get through already, right? So let's start off with WGX, please.
I've clicked on the wrong one there. We want the ASX listing. Yeah, it's been in a bit of a holding pattern over the last few months. This one, but it looks constructive. Like you can see a great rally through 23 and 24, and often you get consolidations. It looks like it's a consolidation. Had a bit of time below the moving averages, which is okay. A wide trailing stop could have kept you in this trend and seen off this consolidation, and now it's back above the moving averages. So that's good. I would I think often what we see when we see a stock go from below the moving averages to above, we get a bit of a sideways consolidation, which is currently going on. But look, maybe there's some more. There could be like a few more weeks of sideways in this. Like it'd be nice to see that sort of pattern develop. It doesn't always develop, but we often see that type of pattern, and that's when the moving averages will continue to catch up. So this is where, if we were to see price action like this, I'd be interested in buying the dip back to the moving averages, or alternatively buying a breakout should prices rally back above these high points. If I had it in my portfolio, I'd be very happy keeping it, and it's one of those ones where you could look for opportunities to add to a position or maybe initiate a position. But I think there's certainly upside potential in WGX, particularly with what the gold price is doing at the moment. So it makes sense from a sector position, and also from its individual price action.
Yeah, gold is certainly doing well in this environment. So let's have a look at MQG, please.
Yeah, quite a bit of damage done to the technical structure there. Let's see how deep that decline is. Yeah, 20%. So a wide trailing stop the sort of trailing stop I use would be able to see off that sort of pullback so far. But it's certainly not a dip I'd be looking to buy. If I had this, and I'm happy, and I'm running a medium term view. Maybe I've had this for a while. This is a sort of stock which could have been held since soon after the COVID crash. We could have got a signal for it with a wide trailing stop. All of this could have been just measuring everything. Oh, look, maybe that was too deep to sit through. It probably was. Yeah, look, I think maybe a position could have been initiated early last year, and that could still be being held with a wide trailing stop, but I probably wouldn't be giving it much more room here. It really does need to stabilise around current levels and start to build out a base and make its way back higher. It's certainly in a weakened structure. It's on the wrong side of the moving averages, so it remains vulnerable. Hence, I wouldn't be looking to initiate a position, but I could keep holding it but I would want to make sure I did have an exit plan should it continue to deteriorate.
All right, let's have a look at the two big miners here, BHP and Rio, please.
BHP, we've still got these declining moving averages and it's still below this overhead resistance, which comes in at around 42. It's been largely range bound over the last couple of years, but with a downward bias. If we look at it from over the last 14, 15 months, I wouldn't want to buy it at this point here, because the structure does have vulnerability to it. It's below declining moving averages. It's had a couple of attempts at starting to push high, but hasn't really been able to make much headway with that. So until we can see BHP get back above rising moving averages, maybe back above this 40-42 zone, and then show signs that it's sustaining it, I'd probably rather just leave this one alone. We could get a great trend in resources at some point. I'm sure we probably will, but at the moment it's not there. It's like buying it today is like buying it last July. Like, why buy it last July? That hasn't panned out. Maybe this will be different, but we've still got that general path of least resistance appears to be to the downside. One I'm watching it myself, but I just haven't had the cause to get in and buy it. Actually, I did buy it back in. Actually, I did have an attempt at buying it. Just quickly jumping back, I bought into this rally in September last year, but then it quickly faded out, and I sold it and got a rebound back, and I sold it. So I just took a small, relatively small loss, only a few percentage points really, and then moved away. Said, okay, this attempt to break out didn't play out, so I'll just go to the sidelines and wait for the next signs of some sort of positive momentum coming in. And it's going to be the same with Rio. Rio looks stronger than BHP. Look at the moving averages; they're just going absolutely flat sideways, and you can see this trading range that it's in. I'm just loosely drawing these, not lining them up properly, but you can see this compressed trading range. Which way is it going to break out of this range? I think whichever way it breaks, it does. Probably keep an eye on the February low and the February high, and whichever one of these breaks first probably gives us an insight to the next round of momentum. For me at the moment, it's just one to watch, but yeah, at some point there's going to be a good trend in these stocks. I don't know when. We just got to wait till the market shows its hand.
All right. Next one is DUR.
It's an interesting stock because it's really holding its own despite the volatility we're getting in the ASX. It's a motion trader stock. It's, if I had it, I'd hold it. Would I buy it at this current point? It's like what one strategy could be, if someone was interested in buying it, would be using the recent high, using the March high as a trigger, saying, look, okay, it's pulling back at the moment, so maybe I don't need to buy this pullback in this current environment. Maybe now's not a buy the dip time, even though the structure of this individual stock looks good on its own merits. It is probably still going to be, the movements of the ASX 200 or the broader market is going to have an influence. So rather than buy the dip, maybe it's a case of, if we see a breakout, buy the breakout, buy a break to a new high. And if it's going that much against the grain of the market, maybe there's something going on beneath the surface which suggests this is a stock we'd want to be in. But most stocks will do their best work in the right environment. It's just such a tricky environment at the moment with its added uncertainty, and market's always an uncertain place. But when you've got prices above rising moving averages, you can feel the odds are somewhat in your favour. When you got markets, as we've discussed, below those moving averages, you got the tide. It's just going in the wrong direction, and that's going to be a impact on individual stocks as well.
Okay. One general question here, but before we move on, based on the 2022 charts this is from Macouse, by the way, particularly with the MA death cross, doesn't that suggest it would be prudent to sell off some holdings before they hit the 10 times ATR stop loss?
Well, that's a tricky one, because what if this turns out to be, what if, and this is all what ifs. So one scenario, well, okay, well, maybe the ASX 200 is about to do what it did during 2022, and it's going to have a pullback back towards 7,000, and we say, okay, it's went into a bear market, in which case most stocks will probably hit a wide trailing stop. So a wide trailing stop can survive a fair amount of volatility, but it typically won't survive a bear market. So if we see if this is the price action we're going to get in the ASX 200 over the next 6 months, well, you look back and go, well, I should have sold, and I shouldn't have used a wide trailing stop. I just should have sold earlier, because of course that was going to happen. But what if it doesn't happen? What if instead we get price action like such? Maybe we get a retest of the low, and then we get a rally, and we get volatility which is messy but within a range before the market starts to turn higher. In which case we might be able to say, look, the market held above support. It was messy, it was volatile, but it generally held in. If I'd used a wide trailing stop and not preempted what hasn't yet happened and which may not happen, well, maybe you've gotten yourself out of stocks which you could have held and maintained a winning position for a lot longer. So we don't know. This is like the trailing stop's not like a point which will as soon as it's triggered, the stock falls a whole lot further. Sometimes it nearly gets it. Sometimes it misses it completely. We just don't know. It's a risk management strategy which does give us downside, does help mitigate our downside, and helps keep us in, because we don't know what's going to happen. Is this going to be protracted sideways, or is it going to be deep bear? We don't know. So without knowing the answer to either of those, I still think the wide trailing stop is the preferable position. There's nothing wrong with lightening a stock, maybe. There's nothing wrong with doing anything. If you really want to, of course, preempt your stop loss and get out early. But just bearing in mind that various scenarios could play out. You can scale out of positions. You can de-risk by lowering exposure to the market. All sorts of ways you can do things. But it's mostly about, I think it's about having a plan and being pretty good at sticking largely to the plan. Yeah, if you fray at the edges a bit and do things a bit differently, I do things a bit differently sometimes, but more than not, I try to stick to the plan. And that's what pulls us through, because you test the plan during bullish phases, during bearish phases. And the idea is then, when you're going through the bearish phase, you stick to the plan. You don't then start doing something else, which is untested. Because then what's the point of having wide trailing stops if you're always going to be jumping ahead of them when things get rough? So it's, that's, I think the best we can do is consistency and as I keep saying, following our plan.
All right, next stock on the list is BVS.
Okay, so yeah, we've got this annoying delay with the prices today. So let's come back to the moving averages. At the moment, the trend is still intact, even though we can't see the rest of it at this point. But look, this has been an upward trend. It's come back to the moving averages, and it's still intact. I'd be using the wide trailing stop, and I'd be trying to stay with this one. There's nothing to say it can't bottom here and move sideways for a while and then go higher. We don't know, but at this point, the trend, as I say, the trend is intact, and I'd be using a wide trailing stop.
Okay, next one on here is CDA.
Well, this underlying trend does remain in place. It's been in a consolidation phase over the last few months, and this is a stock which does go through long consolidations. You can see what happened during 2003. It spanned a good portion of the year just tracking sideways. There's a spike to the downside. This is why we use wide trailing stops. Why I use wide trailing stops. Get these spikes to the downside, which a wide stop can see off, and then stay in a position while it's consolidating. And just to our previous question, should you preempt the wide trailing stop going off? Remember, 2023 was a rough year in the market, and a lot of stocks would have hit their trailing stops. But if you had a wide trailing stop on Codan during that period, you didn't have to get out. You could have seen out a volatile year, stayed in the stock, and you're in there when the trend extends higher. So you can, let's just jump to, let me just make the point by just ducking back to the ASX 200, and it will come up in a moment. Yeah, so I don't know. We've got this issue with the don't know whether it's the internet or the website or the browser or what, but yeah. So look at 2023. Look at this decline we had in the market. So not dissimilar to what we're seeing now. We could have looked at the same sort of structure and said, look, should I just this is just going to keep getting worse. Should I just close things before they hit their stop? In this case, it was one more new low and then reverse. Could the same thing happen again? It certainly could. I don't know, but it could. So this is why we use wide trailing stops. Wide trailing stop could have kept you in this stock the whole way through 23, and then you're in place when the trend accelerates. Whether that happens again, I don't know. But at this point, if I had this stock, I'd be holding it. It's had that sharp move down. I think this is an important low. If it breaks below the March low, well, then it's probably there's a good chance that we see further weakness then continue to come in. But I like that rally off the low, straight back above the moving average, maybe consolidation. Yeah, happy holding it. And it's a gold orientated stock as well, from what I understand. So it'll be an interesting one to keep watching.
All right. Next one is TWE.
Look at this trend. This just continues to deteriorate. This is a sort of situation which I want to avoid being in. There were signs that we had that maybe this was starting to turn higher like early last year, but then it quickly started to fail. And for me, this is a stock I wouldn't be in, because the structure's been vulnerable for a while now. You can see all this price action below declining moving averages, and that's where the vulnerability opens. And vulnerability doesn't mean it has to fall, but if a stock's going to fall, it's much of the damage is typically done below the moving averages. So it's like just compressing a little bit more. There's nothing to say this can't continue to go lower. If this was in my portfolio, I'd want to move it on. But that's just me. Everyone has to do what's right for their own portfolio. For me, it's on the wrong side of the moving averages and it's trending in the wrong direction. So I look at this as a risk, as a great risk to capital. I don't want it in the portfolio.
Okay. Next one is AAC.
Well, this is an interesting one. It's got a signal for this about a month ago, and it's been trading side. So it's had this lengthy decline. So this is they own a whole lot of land with cattle on it. I think Northern Territory type stuff. You got to go check all that out for yourself. But long decline. Then we've got this lengthy sideways period, and it seemed to be breaking higher in late February. Out of this, you can get a bit of a range through here. It looked like it was starting to get some momentum to break higher. It's since pulled back over the last couple of weeks, but you look at what the market's done. That's probably not too surprising. If I bought into this breakout, I'd still be happy holding it. But I'd like to see it really start to hold around current levels. There's probably some support. Like if you just look across, there's probably some support coming in around $1.40-ish. That's where the moving averages is. So I wouldn't like to see this back down at $1.39. That would then negate this strong upward phase, and then look like it's just more chop within this large range. I wouldn't buy it at the moment. If I was interested in buying it, I'd like to see it stabilise first, and then start to lift higher. And if it can do that, well, then that'd be a really interesting stock to consider from the buy side, if it hadn't already been bought. So for now, if I bought this early strength, I'd give it the benefit of the doubt, see if it can stabilise. But if we get much more weakness, well, then it becomes one which, look, it hasn't worked. Maybe consider moving it on. But at the moment, benefit of the doubt. Interesting structure which has a potential for higher levels.
Okay. ASL.
It's a bit messy, this one. We've looked at this a few times and I find it a bit of a messy one. We had this nice trending phase, and often you get these stocks which have these great trending phases, then they get messy for a while, and maybe this is within this messy period. Yes, it's rallied off the lows. It's been above the moving average, but seeing this pullback it's having now, could it just spend a whole lot of time just chopping within a larger range? It's not a stock I've got a good feel for here. It is above the moving averages, so if I had it, I could keep. If I bought this breakout just a few days ago, I'd probably give it a bit more time, see if this pullback's just something temporary which quickly stabilizes. Not one I'd be hurrying to buy. It's like from having a stock go from 25 cents up to $1.60 odd. It's a big gain in a relatively short space of time, about 9 months, 10 months. I just feel it could be one of those ones where the big gains have been made for now, and it just goes through a period where it's just choppier and harder to play.
Okay. AMI.
Yeah, this looks interesting. It's waiting for the rest of the chart to load, but you can see we're above rising moving averages in a difficult environment, and it's also recently broken out of. I'm just quickly drawing it so the lines don't match up perfectly. Nice range, breakout, pullback, rally. I definitely want to hang on to this one if I had it, and just getting a little bit more information. And it's coming off a low base. Yeah, really interesting one. I could even consider buying a position at current levels. It is getting a bit away from the averages. Maybe there's a bit of consolidation to come. But if I liked it and I wanted to be on board, I could consider maybe even just a partial position now, because it is going in the right direction. It's going against the grain of the market, so that's all a good sign. So certainly one I'd want to hang on to and consider a possible purchase.
Okay. NAN.
NAN.
Yep.
I think this has been doing okay in nanosonics. Yeah, it's above above rising moving averages. It's one, if I was on it, I'd be happy to stay on it. Probably wouldn't be in a hurry to buy it, because maybe it just had a spike higher a couple of weeks ago and it's quickly given a bit of that back. So maybe there's some more consolidation to come. But if I was on it, it's like it's coming from. Like this could be the start of a recovery phase. Maybe there's a consolidation before another leg higher later in the year. Getting a bit ahead of ourselves with that, but I think the simple case is if I was in, I'm happy to stay in. But if I wasn't in, I'd probably watch it and see whether we get a consolidation before considering maybe getting in.
Okay. MAU.
Yeah, so this has been an interesting stock. It's gold stock, and it is. I like this little tight consolidation that it's doing. We've had this strong rally off the moving averages, and throughout this volatility in the market, we're seeing it just track sideways within this tight range. So it suggests that, well, firstly, I like that it's holding on to these gains so well, which suggests there's interest in buying it. Not far from current levels, not far from the recent highs. So it's being underpinned. The pullback's being underpinned. if I had this, very happy holding it. Could even consider getting some at current levels just to see whether, because often this little tight consolidation, a strong rally into a tight consolidation, often resolves to the upside. So yeah, it's one of those ones which I could even consider buying in the current environment. Gold related, and of course, most things gold are running at the moment. So yeah, certainly a more speculative play to consider.
Okay, next one along is ILA.
Haven't heard of this one before. So there is yeah. Look, it's certainly got a case for it. It's been moving higher with these rising moving averages, and it's been going sideways over the last few months, but it's generally holding onto its gains. I'd probably want to buy into strength with this one rather than buy the dip. So had I happened to have bought at lower levels, well, fine. I'm happy holding it. Wide trailing stop, risk giving back much of the gain so far to stay on something which could get bigger. But if I wasn't in, I'd probably look at maybe it's a case of just looking at this resistance across there around, say, around 20 cents, maybe around 21 cents that it's a buy, and then it's trailing stop back below the 100-day moving average. That's probably the way I'd play it if I was to play it. I probably wouldn't play this stock though. It's probably too, looks like it's reasonably thinly traded as well, just by looking at the price action. But that's not to say that it can't be done, and it shouldn't be done. If someone likes it, they like the speculative end of the market. There's a play there where the risk can be managed, and the upside could be considerable.
Okay, MM8.
Yeah, well, this is to say that just because the ASX is below its moving averages doesn't mean everything is. And this is the thing which I'm noticing in the resource sector. There are a number of resource stocks which are doing their own thing, which are completely decoupled from what the ASX is doing, and this is one of them. If I was on it, I'd very much be happy holding it. Wide trailing stop. Trailing stop's going to be way back, a lot below current levels, and give it lots of room to move around. I wouldn't be buying it at current point though. It's just too hard to manage the risk on it now for an entry perspective. The last entry possibility was when we had this consolidation back to the moving averages and prices started to break higher. So I think that was the last point I would have considered buying it, probably around 19, 18 to 18 and a half cents thereabouts. But now it's up and away. So I think it's a case of already being on or not being on for now. But yep, let profits run, see where they go. That's where the big money's made.
MXR.
Yeah, and again, resources doing their own thing. Happy holding, see where it goes. Above rising moving averages. Like, is this just a large basing structure and it's now starting to gain some momentum? It's like, yeah, you just don't know. Don't know where these stocks, you never know where a trend is going to ultimately go. Some go a little way, some go a long way. Which camp this will fall into, we just don't know. So it's like, let a winning trade run. Stay with the trend until the trend gives you enough sign to say, okay, the best part of it's over now, or the odds of it continuing have deteriorated to a point where you need to protect capital. But at this point with this stock, it'd be I'd be letting it run. Wide trailing stop well below the 100-day moving average. Probably wouldn't buy it at this point because it's a trickier one to manage the risk on. Like you're 31% just to get below the 100-day moving average, and we're in a difficult environment. So, if I wasn't on, I'm not getting on. But if I did happen to buy this initial sort of breakout, by all means, let it run.
Okay, great. Let's break this up with a general question. It's around risk again, which is fair enough. We're going to have a few now. With your comments regarding risk, would you consider dropping your motion trader stop loss from initial 25% to 20% or lower to tide out the risk period? Obviously, taking into account that most of your trailing stops are with ATRs, right? But if they're using a percentage, where would we go?
So look, my initial stop is set at about 25%. But I'm also using a time exit. So I sell a lot of stocks before the initial stop is hit, because it can take a bit of time to get to a 25% decline. If a stock quickly goes into a tailspin, yep, the stop will hit and I'll be out at 25%. But often I find that I've got the 60-day time exit. So if a stock is underwater after 60 trading days, then I'll sell it. So I might be selling it at 5% loss, 10% loss, 7% loss, 15% loss. So it's above the initial 25% stop. I use 25% for my initial one and also for the motion trader one, because it's when you're making something systematic and it's trying to increase the odds that you're giving the stock plenty of room to move around to get that positive trade. So we're not trying to day trade or short-term trade. Set closer stops, it's going to be more active. You're going to trigger more exits, so you're going to have a lot more turnover. If that's what you want, that's something people can easily instigate on their own. But if you don't want to be that active, the wider initial stop works well for me, particularly with the time stop. That just helps me get out of those stocks which just can drag, and it takes ages for the 25 to hit. Once it's up and running, then it's the hybrid of the ATR coupled with a 25% percentage. So I'm giving stocks plenty of room to move during quiet consolidations, but I'm also adjusting for a stock's volatility as well. I think the trailing stop is the most important. By all means, play around with the initial stop. I don't have a problem with that, but I think if you want to stay on a large trend, it's the wide ATR stop is indispensable. It's people who try to do a 15% trailing stop, hoping to get a 2-year trend which is going to go 500%. I think they're the ones who are going to be the most disappointed, because their 15% stock just can't see off those pullbacks. We get of between 15 and 30% in large trends. But the initial stop, I think that's more variable. If somebody wants to be a bit more aggressive with their initial stop, and is prepared to be a little bit more active with their entries and exits.
All right, fantastic. Let's get on the next ticker. PLS, please.
Well, this one has been in a bit of a tailspin. Again, it's why we respect the moving averages. And this is a stock which there's been a lot of interest in this stock. And you can see the great period it had during 2020, 2021, 22. And then from 23, it started to struggle. But then people look at it and go, well, when's the next up cycle going to come? But big moves often lead to lengthy consolidations, and some just deteriorate and go into a downward spiral. So far, PLS has been in a downward spiral. It hasn't been able to recapture the momentum from earlier times. And all the way, people ask me about this stock a lot. And it's like looking for the low. Where's the low? Where's the next best buying point for this stock? And the whole way over the last, at least since May last year, it's been below these declining averages. So that's when all the things we talk about, all the bad stuff happens below the moving averages. The path of least resistance is lower below the moving average. It's vulnerable below the moving average. Now, at some point, it may bottom out below the moving average, but we don't know when. So I don't want to preempt it. And anyone preempting the low during 2024, late 24, has been disappointed with more downside. Now, of course, you can use stop losses and stuff. You can have a punt of a low and then get out. But a lot of people don't have the exit strategy. They're buying the low and they're doubling up and they continue holding without the exit strategy, and the whole thing can really become a disaster. Not a stock I'd want to be holding at the moment. The momentum is very much to the downside. Like, who's to say this stock can't get to $1, get below $1? Like, I don't know. I'm not saying it will, but if I had to, so it's $1.60 at the moment. Which will it hit first? Yeah, $2, $2.10 or $1.10. You know, I'd say, well, I think the odds favour $1.10. I think the odds favour it going lower. So again, I don't know, but I certainly wouldn't be buying it, and I'd be concerned holding it due to the potential to destroy more capital. I've got to protect capital. That's the number one objective, because if you lose, it's like if you lose all your chips, you can't play anymore. So I don't want to lose all my chips by holding stocks which are in decline. I've got to take losses, and so I'm ready to play again when I get another good setup. I don't want to get stuck in a PLS.
Mm-hmm. All right. Jen has got her neighbours into watching us as well, so thanks, Jen. And MAF, she wants to see MAF.
Oh, it's pulling back with the market generally, but it's showing relative strength compared to the financials index and compared to the ASX. Whereas the financials are below their moving averages, below the 1500 day, and the ASX is below its 1500 day. MAF has just come back to the 100-day moving average. So it is in a position of relative strength. Whether that means it's going to go against the grain of the market, that's another matter. If I had it, I'd be happy hanging on to it. Just have my wide trailing stop on it. See if we can see off this period of market volatility. If the market over the course of the next 6 months moves into a bear market, well, it may not be able to. The wide trailing stop may not be able to withstand that. But if this moves into more of a multi-month messy sideways consolidation, well, maybe the wide trailing stop can see that off and then stay within a larger rising trend. So that's what the wide trailing stop's all about. It's our way of being optimistic towards the market whilst having a clear cut point should it not continue to play out. For now, I'd give it the benefit of the doubt.
Okay. CHN, D Smith.
Haven't seen this for a while, which is a clue that it has been not doing much. And like it's another one like PLS, which big upward trending period, and then it's just been doing nothing but ruining capital, really. There were some signs late last year that maybe it was getting some momentum, and then it quickly gave those back below the averages. I just want to leave this one alone. There's nothing to say that, I know people will be probably looking at this thinking of a base, but what if this isn't a base? What if this is just like maybe that's the top. What if this is just like a holding point before another excursion to the downside? It's there's nothing to say it has to base here and turn higher. It could, but it could also break from this range and head lower. I don't know that it will do that, but just got to be open to all sorts of scenarios, and they're not all bullish. They're not all bearish either. But at the moment, the price action doesn't give me any confidence to buy this stock. If I was in it and I was, look, I think an important point to watch would be this support here along 87 cents. If it were to break below there, it would be a sign that there could be another significant downward move, and by then it's like it's running out of runway before it hits till it hits the end point. So I don't know. It's a stock I'd be concerned holding. I'd be looking at how am I going to protect the capital I have in this stock? To buy it, I need to see it get back above moving averages and start to break above $2. Then we can look at it. But at the moment, it's a high risk situation.
Okay. Another general question here. I know you're a technical analysis guy, but when you get buy signals on a stock, do you then look at what the stock is invested in?
No. People look at me. Some people look at me with a bemused look when I say that I don't know what at least half the stocks in my portfolio even do. I just like it's. I'm looking at price action and I'm managing risk around price action. So they're just stock codes to me, and it's like some of them I know. Like I recognise the gold stocks and some of the because I'm playing at the smaller end of the market. I'm just not familiar with most of the names that I get involved with, and that's okay. I know the fundamental people they'll just be shaking their head, going, "This is just high risk. This is just gambling," because they don't understand what I'm doing. They don't understand the systematic approach and the risk based structure around a process, and that's okay. They can go and do their thing, and that's fine. But this is a systematic price action orientated process where I buy stocks which are rising in price above rising moving averages, and then let those stocks run for as long as they will run. And if the price action starts to deteriorate, there's that calculated consistent exit point. So I can keep the whole thing asymmetric in that my risk is I can have 1 unit of risk with 3 units of potential upside. And if I've got a win rate of around 50%, maybe a bit under 50%, I can do very, very well with a 3-to-1 type scenario with my risk reward. So no, I don't look at the fundamentals. The fundamentals can often throw me out. Like one of my best stocks that I've been in was a stock called Calix. It didn't have earnings, and it had no earnings. So on a fundamental basis, would have been like, well, this is an expensive stock with little revenue and no profits. But it went up 500%. It was all based around price action and managing risk around the price action. Nothing wrong with doing a fundamental overlay. That can be also useful sometimes when you find a situation where you've got great price structure and a supporting fundamental story. That can be a good thing. There's nothing wrong with doing that, but it's just not what I do.
Okay, a couple more to go through here. CKF.
Like, this has triggered a signal. So this is a motion trader stock. It's triggered a signal last week. You can see it's gone lengthy period below the moving averages. It's just gone above the moving averages, consolidated for a bit. Moving averages have now crossed. So the moving averages crossed on the 18th of March. That didn't trigger a signal. For me, I need the moving average have to be positive, and then the stock has to move to a 70-day high. So it's an extra hurdle to help avoid situations where the stock moves higher, the moving averages then cross, and then it starts to roll over again. So we can avoid an unnecessary entry by having that requirement for it to make a new high. So I did that last week. It's pulled back a little bit. That's okay. So it meets the entry criteria for a trade. I would and I'd consider taking this one. I won't in CKF because I'm focused more on the smaller end of the market. This is a bit larger, but it does have that initial criteria. It's going against the grain of the market. I guess like if someone was looking at it now thinking, well, should I buy it? I'd probably say if I didn't buy the initial signal, given it has pulled back, I'd say rather than buy the dip, sometimes I'd say, look, this could be a good dip to buy. But with the grain of the market, the trend of the market at the moment being vulnerable, I'd probably say, look, see if it consolidates and then breaks to another high. And so it's like a secondary or a tertiary confirmation. and then maybe take a position there and see whether it can push higher. But it does meet the criteria for a trade. But as I've said, more signals fail when we're in volatile or bearish conditions. So maybe it won't play out. But it's certainly a stock worthy of watching.
Okay, last couple then. APE.
Yeah, well, this is doing its own thing, isn't it? It's been trending above these rising moving averages. This is why, like at the earlier in the show, we talked about that stock I recently bought, and this is why I bought it, because even though the market is selling off, some stocks can go against the grain, and this you can see that gapped higher despite the market selling off. So that's why I'll consider signals, even if it's only a half position during times where the market's coming off, because some stocks will do their own, follow their own path. If I was in APE, I'd be happy holding it. Yeah, look, I'd be happy holding it and going with the trend, see where the trend goes. Not in a hurry to buy it though, given it has had this extended run and it's pulling back a little bit at the moment. But yeah, it's certainly one I'd hold. Wide trailing stop back below the 100-day moving average.
All right, now this is the one that's on my mind as well, Jason, because I certainly hold this one. TUA. What's the status?
Isn't this an interesting one? And I've got it too. So the wide trailing stop kept us in during this. Like this is just a strange day. So they the profit results came out and they appear to be good from what I understand of them, from what I've seen written about them. They were positive numbers, and the stock opened higher. You can see the stock gapped higher on the open, but then it was met with substantial selling. So I don't know where the selling came from. I don't know who was exiting. I haven't looked at the announcements over the last few days because I'm not really going to trade off the back of them. They're just for curiosity. But for whatever reason, there was a sharp sell-off, which went on through the day. It wasn't just like a 10-minute sell-off. It was persistent selling through the day. And so the wide trailing stop comes in at around 470, 480 thereabouts. So just saw that off, and that's why we have a wide trailing stop to see off bouts of volatility. So it did its job from that respect. But if this then does morph into a larger decline, well, it won't see that off. It will then trigger. So at the moment, at this point, I'm still in. It's interesting to look at this on a 5-minute chart. So you can just see it. Like at the moment, we've just got one big bar going down. So here it is here. So it tells a bit more of a story. So you can see the how the selling started, and then initial attempt to buy the dip, and then they kept selling, and then selling draws in selling. People are looking at, they go into their account and they see their stocks down 15, 20% in a day, and they start to sell, and the selling feeds upon itself till it got to a point where all the panic selling then comes in, the capitulation selling, and it got to a point of everyone who had wanted to sell had sold, comes back like a spring, but now it's moved into okay, where's the next move going to come from? Is there going to be interest in really starting to buy this back up and take it higher? Or are people going to look at this now the dust is settling and go, no, I want out, and push it down, and we see the low from last week break, the stop trigger, and maybe it goes into a larger declining period. I don't know which way it goes at the moment. It's I don't know. It's one to watch, and it's one to just I think it's to be guided by the price action. If it can hold on to Wednesday's low, well, maybe it can make its way higher again. But if it breaks Wednesday's low, I'll just say, well, it's been a great trade. I'm up whatever it may be, a couple of 100%. I'm in from back down here somewhere. If this is the end, well, so be it. But I'll give it a little bit more room. There's a heap of technical damage done. the odds are probably swinging towards it being the end of the line, but it's not there yet. I'm certainly not going to preempt the stop because I have seen these things push back higher in the past, but I think the odds are shifting towards. If it was going to shift back, I probably would have liked to have seen a sharper retake of the moving average rather than just bouncing and now sitting. I think the sitting part makes me think, well, maybe there's going to be a test of the low, and a test of the low is pretty close to my trailing style.
Yeah. All right. Good one. We're going to finish off on a question that's probably been answered a little bit, but why not confirm around these risky times? Just quickly around the moving averages that Jason's using on screen. They're just the 50 and the 100 exponential moving averages. So there's a question there that says 50 SMA and 200 SMA. And they're the 50 and the 100 exponential moving averages Jason's using there. But obviously there's no magic moving averages. It's just the ones that we're using.
Like in the back testing I've done, I don't think it really makes a great deal of difference whether you're using simpler or exponential. They're similar. They're a little bit different. Sometimes the simple gives a better outcome. Sometimes the exponential gives the better outcome on an individual trade. But when you back test them all, I don't think there's a significant difference. But you've got to make a choice. Which one you're going to use? I use the exponential simply because I like the concept that they're a little bit more responsive to the latest price action. So they'll turn a little bit earlier than the simple moving average, which is waiting the 200th day, the same as the current day, whereas the exponential will wait the current day a little bit more than the 200th day. So conceptually it sort of seemed like a nice idea, but when I back tested it all out, I don't think there's a whole lot in it.
All right, fantastic. Lastly, one from Kirby. An ATR stop will keep you in positions that go sideways for a long time as opposed to an MA stop. Do you ride these out or lose patience and cut them at some point?
No, I ride them out. It's an example in my portfolio at the moment. I think this is the one. Yeah, this APZ stock, Aspen Group. I think it's property related. I've had this for quite a while. I think I've had it since 2021. And look at this period of not doing too much between a couple of years. It really didn't do much, except pay dividends. It's paid quite a bit of dividend during that period. So, and when it's one stock within a wider portfolio of maybe 30 or 40 or 50 or up to 80 stocks for me, it's it doesn't matter if it wants to go sideways for a year and pay dividends, fine. Because it's just staying on that longer trend, which the ATR stop does a good job of doing. And you're right, using a moving average for a stop, a moving average will not see off periods of consolidations typically because as the price goes sideways, the moving average comes in and collides with the price action. So I prefer the 100-day or a 200-day moving average. It's a reasonable proxy for a trailing stop, but it doesn't account well for consolidations if you're trying to stay on maybe a 1, 2 or 3 year move, in which case I think you're better off with the wide ATR stop, which will sit below do a better job of sitting below the price action and then moving up with it. So yeah. Plenty of patience to sit with that. Patience is part of the game. Patience is where the big percentage gains come from. If we're trying to be too quick with everything, we're then probably settling for less than we could get if we're prepared to sit with something for a bit longer.
I like that. Let's end on that. Percentage comes with patience. All right. So that's the philosophy of the day here. All right. I think we're done for today. Great show, Jace. Lots of tickers there to have a look at. Lots of lessons learned. Once again, thank you very much, everyone, for coming again. We will see you again next week. Don't forget, as always, to like and subscribe and send us comments. We love seeing these compliments as well. I think the other thing is to remember that if you're coming consistently, this is part of the routine of becoming a good and a profitable, investor and trader over time, coming consistently to the educational side of trading and investing as well. I think it's a huge part, right? Not thinking that you know it all and all that, is important to be humble and continue to learn, even if you know concepts. So it's good that everyone keeps on coming. I love seeing the same people back in every week, and I love seeing new people as well, as I'm sure you do, Jace. Thank you.
Absolutely, it's been fun, and look, I enjoy talking about all this stuff, and we talk about the same concepts quite a bit, and I think that's important. That's all part of repetition. It's all part of learning, and rather than talk about something once and never readdress it, the more we discuss stuff, the more ingrained it becomes, and you want to make a habit of good process. Hopefully, that's what we help people do. So yeah, Rog, been fun, been a good show. Look forward to next week.
Fantastic. And don't remember, we are general advice only. So do your own research, do your own diligence, and make your own decisions. And we can't wait till next week. So thank you, everyone. See you later.